Just give me confirmation. I'm going to share my screen. So let me know if you can see my screen now. Okay, so during the webinar, I want you guys to interact as much as possible, right? If you guys have any doubts regarding your paper, any drafting issues, or any just common doubts, then please write down in the chat box, and I'll try my level best to clear your doubt, right? So we will be starting with the webinar for SBR. This is a second day. Our focus is going to be on revision of the standards, as well as we will be solving a complete section B question from your September-December 2025 paper. Right. So I'm Afshana Afrin. I'm an ACC affiliate. I became a ACC affiliate on approx October 2025. I did my Bachelor's of Commerce from Jamia Millia Islamic University. I also did MBA in Finance and Operations. I have been a SBR World Rank holder where I scored 93 out of 100. And right now I'm a mentor for FR and SBR at BNACC. Right. So as I mentioned before that, as I mentioned in yesterday's webinar, that the pass rates of SPR is between 49, 48, 50, 51%, right? Which is actually very nice. Right? It's actually nice, and this should be motivating you guys that you can pass this paper, right? It's not any rocket science. As long as you know the accounting standards, as long as you can justify your opinion, like even if it's not matching with the examiner answer, there's no problem. As long as you can justify and it makes sense, the examiner is going to give you marks, right? And these are some of the feedbacks I got from my students for the SBR test series I conducted. So you guys can quickly go over this, right? I hope you guys have gone through the September-December 2025 question paper. Okay, so we are on the second day of the webinar. If you are someone who has missed out the first day, there is no problem. It will soon be uploaded on YouTube. So you can completely catch up on the entire webinar on YouTube. I think by evening, the webinar will be uploaded. So in the first day, we focused on certain points from the examiner report. Why is what is examiner focusing on? What's the reason why students are failing SBR? Like what are the common mistakes in answer drafting? So these are the points which the examiner has mentioned. So this webinar, the first day, is something which you should definitely catch upon to ensure you are not repeating the same mistakes, right? So in the second day, our focus will be revision of some of the standards, right? Since we are going to solve September-December 2025 section B, we will first revise the standards. Okay, and then we will apply those standards in the case, right? That way, it will be easy for you to recall the standards, and we will also focus on some of the examiner comments, like right, what are the common mistakes again your friends have done in the past. So we will also focus on the examiner comments. Then this day 3 of the webinar, which is tomorrow, our focus will be again revision of remaining standards. Right, we will focus on those standards which we won't revise today. We will focus on section A of your September-December 2025 paper, and along with some examiner comments. Right. So we know the exam format. We know the exam format. Section A, it's 50 marks. Section B, 50 marks. In section A, there are two questions, 30 marker and a 20 marker question. And there is two professional marks in your second question. Right. And those 2 marks can be those 2 marks are free marks for you as long as you are writing your answer with proper clarity. Right. Normally, they give you 2 marks just for writing the clarity and actions for ethical issues, right? So, if you are explaining your answer well, if you are properly giving descriptive analysis of why it is an ethical issue, then you are going to get two marks for free, right? Just for free. You don't have to do anything extra. You just need to write your answer in a more professional and detailed way, right? So, you have two professional marks in your ethics question. Then in your section B, you have two questions again, 25 marker each. And here the focus is on various accounting standards, right? In one question, they can ask you 4 to 5 different accounting standards, right? So anything can be asked in your paper. So please, we still have few days left. Focus on revision of the accounting standards, right? Don't go in very deep of the accounting standard. Don't go in the depth of the accounting standard. Instead, try your level best to cover as many accounting standards possible. Right. Because if anything comes in your paper, you should be able to write at least 2 or 3 lines of the accounting standard. Even if you don't know how to calculate, even if you don't remember the accounting treatment, you should at least know the basic of the accounting standard. And this is possible only if you cover the entire syllabus for SBR. Right. And you have two professional marks, and this is normally again for the quality of your answer in your fourth question. And this will be about investor perspective. Right. So investor perspective, again, since if you are not dealing with your time properly, then you are going to miss out the fourth question. Right. You might not be able to complete the fourth question. And in fourth question, you have investor perspective, shareholder perspective question, which is so easy. Those are again 3 marks for you, right? If it comes for 6 marks, okay, you have 6 free marks for you, right? Plus you have 2 professional marks, which is again 2 free marks for you. So you have 8 free marks only if you properly manage your time and you reach towards the end of the paper within the time limit, right? So focus on completing the entire paper. Very, very important. If you want to pass the paper, you have to complete the paper. Right. In your investor perspective, one thing I always say that the question will be super random. Right. There's nothing which you can memorize and learn for answering your question number 4. Right. They will always have something which is super random. So you need to go through the case. You need to write points which you think is correct. Like you write your own point of view. You are going to justify your point of view, and that's it. You will get marks over there. Right. But then that only works if you properly justify your answer. Right. If you simply write 1 or 2 lines, you are not going to score marks over there. So your focus should be to give proper analysis of the case and whatever the requirement is asked. Right. So now we will focus on revision of the standards. Before that, if you guys have any doubt, please ask. Okay, any doubts, guys? Take 1 or 2 minutes and let me know if there's any doubt. Okay, do we have no doubts? Shall we start with a very quick and brief revision of the standards? Right, these are the important aspect of every standard which you should know, right? So I have tried my level best to include at least like 50% of the accounting standards. So we'll start with IS 21 foreign exchange rates. We know that if we get a question on foreign exchange rate, it's necessary you know which exchange rate to use. By chance, if your calculation is all correct, You have made a very nice format. But if the exchange rates are wrong, if you don't know how to convert from a foreign currency to a functional currency, then you're losing marks. And that's not any rocket science. You should know how to identify the functional currency. You should know which is the presentation currency, right? You should know which are the exchange rates. So for translation, the opening rate is normally the rate which is, suppose a payment has happened. If you have entered into a transaction on 1st April, then the exchange rate of 1st April will be applied, right? At the year end, if the year end is 31st December, then the closing rate of 31st December will be used to translate the monetary items, right? If there is any impairment expense, like if there is any P&L item, then for that we always use the average rate, right? For profits, for reserves, we always use the average rates, right? So whenever it is an item from your SOFP, we use the spot rate and then the year-end closing rate, right? We find out the difference, we get the exchange loss or gain, right? And if there is any SOPL item, then we use the average rates, right? If there is any exchange difference on foreign associates or any foreign transaction, it will go to your OCI, right? Any cumulative exchange differences is recycled to P&L. Translation reserve is released on disposal, right? So in your key exam areas, you should know how to, account for any foreign exchange transaction is happening. You should know difference between monetary item and a non-monetary item. You should know when will the gain or loss go to OCI, when will it go to P&L, when will recycling happen, right? Then we have IAS 28, which is investment in associate. Again, simple investment in associate is equal to equity method of accounting. But then if in your answer, if you simply write equity method of accounting, you won't score marks. You need to explain what is equity method of accounting, right? You need to explain it's a one-line accounting and how will it go in your SOPL? How will it go in your SOFP? Right? You need to explain. Simply, if you write one sentence, it's not going to score marks. So associate is normally when there is significant influence, which is normally around 20 to 50%. And you should also know what is significant influence. Right? You can't simply write that the company has significant influence. You have to explain what is significant influence. How is it a significant influence? If you're saying A company has significant influence over B company, you should quote case sentences from the case and then specify because of this, we can say that significant influence exists. You have to mention about equity method of accounting. If the question is asking you about accounting treatment, then you need to mention equity method of accounting. You need to show entire you need to mention how it will go in your SOFP and your SOPL. Now, if in the question they have given you figures, right? If they have given you associates profit, if they have given you cost of investment, then please you need to do calculations, right? You need to do calculations. If examiner is giving you certain figures, then you need to use that in your answer. Don't ignore any figure which the examiner has given to you. Right, because I know I have checked papers and I have realized that you guys are writing half of the answers. You guys are explaining what's equity method of accounting, but you have not shown me how much will go in SOPL, how much will go to SOFP, right? So if by chance, if examiner has given any figure, any numbers in the case, then you need to show the calculations. You need to show how it will go in SOPL, how it will go to SOF, right? So equity method, simply the cost of investment plus any profits and minus any dividend from the associate, right? Initial cost plus any post-acquisition profit in the parent's share, right? Entire associate's profit does not come to parent company. If the parent company has 20% of associate, only 20% of the profit comes to parent company, right? If you forget this, you are losing your marks, right? You have to subtract any dividend you are receiving from associate again in the parent's share, right? If the associate has sold anything to parent and there is unrealized profit, you need to subtract in the parent's share, right? These are tiny mistakes which you can do and lose your marks. If there is any loss of significant influence, for example, if if the company has completely disposed of the shareholding in the associate, then you're supposed to re-recognize the associate. You will recognize retained interest at fair value, and any gain or loss goes to P&L. Right? Your step acquisition or step disposal. This is very important in SBR. At least 5 marks, 6 marks will come from here. So you need to know the step acquisition, step disposal. You need to know the journal entry, right? The examiner, maybe they might ask you for the double entry, but then even if they don't ask you for double entry, for clarity purpose, you can show the double entry in your answer, right? Or you can show it in form of your paragraph. Okay, we have one question. Ma'am, if the interest is paid at the year end, which rate is used for translation, closing rate? Yes, if it specifies that interest is paid at the year end, then you can use the closing date. However, if nothing is specified about when is interest paid, right, so we will take the average rate. Okay, see, whatever you are using, whichever rate you are using, and suppose a case like this appears where there is a little bit of confusion which exchange rate to use. In that scenario, write a small paragraph in your answer, right? You should justify which account, why you have taken this accounting, this exchange rate, right? As long as you justify, the examiner will be sweet to you and they'll give you marks, right? So as long as you explain your logic, you explain your judgment, you're going to score a mark, right? Okay, any doubts still here, guys? Any doubts? Okay, so next we have IFRS 9 financial instruments. So you should know properly what happens when it's a financial asset, what happens when you use amortized cost method. You should know in financial liabilities, how will you account for convertible instruments, right? So in financial assets, you know that we have fair value through profit and loss. So any gain or loss will go to profit and loss, right? How will you account the transaction cost? You're going to expense it out to your SOPL. If we have fair value through OCI, then any gain or loss will go to OCI. If you're following amortized cost method, then you will use effective interest rate method. Like you should know the calculations properly. You should know the rules to apply these methods, right? If the company has the business model to hold cash flows, right, to hold the financial asset to to earn any investment or interest in future, in that scenario, you use amortized cost method, right? If the company is getting their cash flows from payments and any principal payments and interest payments, then again you use amortized cost method. If it's a scenario of cash flow hedge, the effective portion will go to OCI, ineffective portion will go to P&L. If there's reclassification happening, reclassified when hedge item affects the profit and loss. In case of convertible instrument, you should know how will you do the proper accounting and calculation, right? Convertible instruments, again, very important. This was there in your, yeah, it's there in September, December 2025 paper. So in convertible instrument, first, you are going to calculate the liability component, then you will compare it with the nominal amount, the nominal value, and you will get the equity component, right? So you should know how this is accounting. You should know how will convertible instrument affect the gearing ratio, how will it affect the financial position of the company, how will it affect the profits of the company, right? So the key exam areas are hedge reserve calculation, redefinition criteria, fair value movements classification, and financial liability measurements. Next, we have IS2 inventory. So the basic rule for inventory is inventory value is always it's the lower of cost in NRV. If the examiner is asking you something about IS2 inventory, first step, it won't take you more than 1 minute. Write the accounting treatment. At what value do you recognize inventory? Right. So we have to write that inventory is valued at the lower of cost in NRV. Always simple. You have marks for writing the accounting treatments. So the basic thing you can do is that you write the basic rule of the accounting standard and then you continue with the case analysis. Right? Always measure at the lower of cost in NRV. If cost will be directly given to you, but in case NRV is not given, you're supposed to find out the NRV. Right? You have to subtract any cost to sell in your to find out the net realizable value. If there's any obsolete inventory, it should be written down, and the written down expense will go to your operating expenses. Okay, any doubts still here, guys? Next, we have IFRS 15, revenue from customer contracts. So first, you're supposed to identify the contract with the customer. Is their contract? Like, is there proper payment terms agreed between between two or three parties? Right? Is there a transaction price decided? Is the performance obligations decided? Right? Is the commitments from both the side there or not? Are they interested in making a contract with the customer or not? Right? So the best first very step is to identify the contract with customer. Second step is to identify the performance obligation. Right? You might have one performance obligation. You might have two performance obligations, right? So you have to identify has many performance obligations given. And if the examiner is asking how many performance obligations are there, then you're first supposed to explain the rules. Like we have some rules for identifying the distinct performance obligations, right? So you have to list down the rules of distinct performance obligation that only the customer can benefit from it, right? The company, the seller is the one who does not have any right to direct the asset. They're making something just for the customer. The customer is using the asset, right? So you should know what is the rules for a distinct performance obligation if the customer can benefit from its use. So first you will list down the rules for the distinct performance obligations, then you will evaluate. You will evaluate whether it is correct or not, whether there is a distinct performance obligation or if it's all a combined, it's just one contract, right? Then we have step number 3, which is to determine the transaction price. Your transaction price can be based on what the competitors are selling. A transaction price can be based on IFRS 13, right? So you should know how to allocate the transaction price to obligations. You should know how to determine transaction price. And if the question is asking for transaction price, if the question is asking you what should be the transaction price of a maintenance contract, you can write, okay, that this is a transaction price, but then you need to justify why are you saying this should be the transaction price, right? There will be something given in the case, so match your answer with the case and then justify your answer. If you simply write that the transaction price should be $200, I won't give you marks, right? You need to give me the reason. Why are you saying this, right? Allocate the transaction price to obligations, and then you have to recognize revenue as the obligations are satisfied. So you need to know when you recognize revenue at a point in time over a period of time, right? There are certain rules. So you should list down the rules if the examiner is asking you. You should evaluate as per the rules, right? You can't simply write that revenue will be recognized on 1st April. You can't simply write that revenue will be recognized over 5 months. You need to give me reason. Why are you saying this? Right? We know there's something called upfront fees in SBR that, for example, the company is charging 50,000, which is the upfront fee for the contract purpose. So in that scenario, we will treat it as an advance payment. It's not a separate performance obligation. It is an advance payment and it is recognized over the contract period, right? We know there's something called contract cost in case if the company has incurred any cost which can possibly be recovered after the contract has been started. In that scenario, that will be capitalized as the cost of the contract. Right? If you expect the cost to be recovered, you're going to capitalize it as the cost of the contract. Right? Next, we have IS 12 income taxes. So you should know what's deferred tax. Like when does it arise? So deferred tax is equal to temporary difference into tax rate, and temporary difference is when your carrying amount is more than the tax base, right? It arises on temporary differences. Deferred tax asset is recognized if future recovery probable. A question might give you a scenario and they're asking if deferred tax asset can be recognized or not. In that scenario, you need to use a professional judgment. You need to specify, you need to give analysis about whether it's possible the company can make future gains or not, against which you will set off the deferred tax asset, right? If there's any contract liabilities, it's a deductible temporary differences. You should know whenever there is a revaluation gain, it leads to a liability, right? It leads to a liability. Then we have IFRS 5 as non-current assets held for sale. You should know the basic criteria for classifying asset has non-current asset held for sale, right? You should know the classification criteria. That is, it's if it's available for immediate sale, if the non-current asset is available for immediate sale, if the sale is highly probable, if the management is committed to the plan, if the delivery is expected to happen within 12 months. Right? In that scenario, it's a non-current asset held for sale. If the management is committed to sell it, right? If it can be sold immediately. If the company is saying that they want to sell a building, but then if the building is not ready for sale, then it cannot be held for sale. Right? If the building is completely ready, the construction is done, everything is ready, then in that scenario, you can classify as non-current asset held for sale. Right? And if you classify as non-current asset held for sale, you're supposed to stop charging depreciation. So measurement of non-current asset held for sale as per IFRS 5 is lower of carrying amount and fair value less cost to sell. Carrying amount, high chance they will ask you to calculate it. So you should know how to calculate the carrying amount, cost minus depreciation, right? Carrying amount on the specific date you compare with the fair value less cost to sell. Then you have to stop charging depreciation on classification if there is any impairment loss. Like if the carrying amount is more than the recoverable amount, then in that scenario, impairment loss will go to your SOPL, right? Basic, if the question is asking you how to treat as per IFRS 5, you should check the classification criteria. You should mention about the accounting treatment. The key rules are that reversal of impairment is allowed only to the extent, right? Only to certain extents. you should present this non-current asset held for sale separately in the financial position. Why are you showing it separately? For better presentation of your of the company's operations, right? For better faithful representation. You're showing the assets held for sale separately, so the ones who are using the financial statements, they can make the decisions wisely. They're getting a true representation of the company. Discontinued operations are also disclosed separately in the P&L. You should know the definition of a discontinued operation. How will the accounting happen? Next, we have investment property. There's certain definitions. Property which is held to earn rentals, or property which is held for capital appreciation, right? So in that scenario, it's an investment property. If the company is having something which is owner occupied, or if it's held for sale in ordinary course, then it's not investment property, right? If I have a building and I'm saying I'm going to give the first floor to someone else for rent, it's an investment property, right? If I'm using the second floor for my personal use, right, then it's owner occupied, and that's IS 16. So you should know the difference between both of them. You should know how to account when there's a change in use. So we have if the company is used, in investment property, there are two models that can be used. We have the cost model, which is basic cost minus depreciation. However, if the fair value method is used, gain or loss will go to your P&L. No depreciation charge, because you're going to remeasure at each reporting date, right? If the fair value was 5 million last year, this year it's 6 million, and 1 million gain will go to your SOPL, right? That should be the accounting if fair value model is used. In case if there is any change in use, right? I used to, like for example, the second floor of my building, I use it for personal use. But then after 6 months into a year, I'm saying that, okay, now I should give it out for rent and I'll move somewhere else. So you're going to consider this a change in use from owner occupied from IS 16 to property, to investment property IS 40. This change in use happens only when there is evidence of change in use, right? If I'm simply saying that, okay, I'm going to move out of this floor, in that scenario, that's not a proper evidence. If I have started a search for someone else, for someone who will occupy my floor, if there is someone who moves into the floor, then those are evidence of change in use, right? So you will do transfer only when there is evidence of change in use. Just management's intention alone is not enough, right? If the management is saying that they want to sell out a certain factory division, right? If they want to rent out a certain factory division, in that scenario, just intention is not enough, right? So IS 16 revaluation is required before transfer to investment property. Any gain or loss is there, it will go to your OCI. And in fair value method, any gain or loss is there, it will go to your P&L. So there is one very basic examination trap, which is if the management's intention alone does not constitute a change in use. Right? In the question, they might say that on 1st April, the management decided that they're going to rent out the properties to someone else. That's not enough. When the third party is moving in, and then they're paying the rent, in that scenario, that is when a change in use happens. Just the management's intention is not sufficient. Then we have IS 16 property plant equipment. So very basic initial recognition will be at cost. You're going to add any directly attributable cost. Subsequent measurement, you have two options, cost model or revaluation model, and then you're going to depreciate over the useful life, right? Revaluation or any revaluation gain will go to OCI, right? If there is any revaluation decrease, like if there is any deferred tax, you're going to subtract from OCI. If there is any impairment, right, you're going to first reverse it from the revaluation surplus, and any balancing figure will go to your SOPL, right? Your depreciation will be based on the revalued amount. If the amount, like for example, the cost of the property, plant, equipment was 10 million and revaluation has happened and now it is of 15 million. So your depreciation will be charged on 15 million, right? So be very careful when you're calculating the cost, when you're calculating the revaluation gain, right? So if there's a scenario of transfer of property from IS 16 to investment property, then first you're going to revalue under IS 16. Any gain will go to OCI at date of transfer, and then you will apply IS 40 from the transfer date. Borrowing cost, there was a question on borrowing costs in one of the latest paper, and a lot of you could not answer that properly, right? So it's important that you revise every standard. So simply, if there is a loan which you have taken for construction of a qualifying asset, right? If you have taken a loan for construction of a qualifying asset, in that case, whatever is the finance cost or the interest cost, that is going to be capitalized as the cost of the asset, right? So borrowing cost is equal to loan amount into the interest rate, which will be given to you into the time, right? If your construction is happening for 5 months, we're going to capitalize for 5 months, right? The cost directly attributable to qualifying assets are capitalized. Qualifying asset is the one which takes substantial time to prepare for use. If I have a building, I have taken loan for construction of a building. Building is a qualifying asset because it will take substantial time to get ready, right? So whatever loan I have got, that loan amount into interest rate into time, I'm going to capitalize as the cost of the asset. So capitalization starts when expenditure, borrowing costs, and activities begin. Right, in by chance, during the year, if for 2 months construction does not happen, then you will not capitalize the borrowing cost during those 2 months, right? So you will capitalize only when the expenditure has been taking place, when the activities are ongoing for construction of the qualifying asset. There are key exceptions where, the investment property under fair value model may opt out. You might capitalize only for cost for investment property. You have to suspend capitalization when there is any interruptions, when there is, for example, there is a strike of labor, right? If there is a labor strike for 3 or 4 months, then in that scenario, we're going to suspend capitalization. We will stop capitalization, right? When the construction of the building is completely done, in that scenario, you will stop capitalization, right? Next, we have IS 36, impairment of asset. This is very important because they can ask this anywhere, right? This can be asked with IS 16. This can be asked with IFRS 5, right? So IS 36, impairment of assets. Impairment happens when the carrying amount is more than the recoverable amount, right? And you should know what is the recoverable amount. Recoverable amount is the higher of value in use and fair value less cost to dispose. So the examiner might give you the carrying amount, but then you might have to calculate the recoverable amount, right? So you should know how to calculate the value in use. You should know how to discount and bring to present value. You should know how to calculate the fair value less cost of disposal, right? They might not give you the direct figures. You have to calculate. And if you're calculating, you should give a proper explanation also, right? Then we have CGU allocation if a scenario of CGU is given to you, right? Cash generating unit is given to you. Then first, always you will, you will impair the asset which is clearly, clearly damaged. However, if there's no such asset given to you, then you can first impair the goodwill, right? And impairment on goodwill is never reversible, right? Case might come up in your paper and it could be like the junior accounting is recommending that goodwill should be impaired. In that scenario, you're supposed to justify, you're going to write that goodwill cannot be reversed, right? Impairment on goodwill cannot be reversed. You should be able to justify and give proper reasoning as to why the junior accountant is wrong. Right. Remaining loss will be allocated proportionately to the CGU assets. No asset should be written down below its own recoverable amount. Right. If the current assets are given to you, remember current assets are always at recoverable amount already. So never allocate impairment to them. Right. Then there are certain impairment indicators if there is any regulatory changes, if there is a decline in the market value, if there is a physical damage or there is obsolete, if there is evidence of economic underperformance. For example, last year your machine used to produce 50 units, but this year your machine is producing only 20 units. Then it's a sign of impairment, right? Impairment test should be done. Next, we have IS 32 financial instruments presentation. So you should know the difference between liability, equity, and compound instrument. You should know the definitions of each and everything, right? So yeah, so it's based on substance and not just legal form. If there is an obligation to deliver something to someone, it's a liability, right? And you should know how will the liability affect the financial position of a company. Equity only if there's fixed cash for fixed shares. If there is variable number of shares, it's a liability scenario. If there's fixed number of shares, it's equity. And if there is convertible bond, you know there is debt and equity component both, and then you're supposed to account for them separately. Right? Compound instruments, convertible bonds, we understood that first you're going to find out the liability and then the balancing figure. When you compare with the nominal amount, you'll get the equity amount, right? So you should know how these impact the financial statement also. So is there any doubt in these, guys? These were some of the very important accounting standards. If there's any doubt, let me know. Okay, is there any doubt, guys? Please let me know. And then we are going to start with our question practice. Right. So I have opened the CVA platform and the question we're going to solve is question number 3 of your September-December 25 paper. Okay, just go through the background of the case and go through the requirement. Okay, have you guys gone through the requirement and the background of the case? Right. Just give me a confirmation once, guys. Hi, am I audible? Just give me confirmation. Hmm, Okay. So I need you guys help for solving this question, right? So there's certain areas where I'll ask you guys to calculate figures. So please answer and then we can practice this side by side, right? So we have a company, Arundel company, which operates in agricultural business sector, right? So you need to know the sector of the business, in which domain, in which sector is the company dealing with. You need to focus on the year end of the company, which is 31st December 20x7, right? And it's given that there are two following exhibits. So I know there are two exhibits, factory closure and new legislation, right? And there are requirements given to you. So what am I going to do? First, I saw the question. I read the background information of the question. Now I will copy paste the requirement over here. Okay. Now I have copy paste the requirement in my answer. In my word processor. So this way it will be easy for me to answer each and every aspect of the requirement. Right. So the first requirement is saying using exhibit 1. So with the help of this exhibit, right? With the help of the first exhibit, I have to, in accordance with IFRS accounting standards, I have to explain with supporting calculations. The effect of factory closure on Arundel Company's financial statement for the year ended 31st December 20x7. Your answer should cover the property, plant, equipment, and the factory building. Right? The property, plant, equipment is for 8 marks, and the factory building is for 9 marks. Okay, so we have so much marks just for each of the cases. So 8 marks and 9 marks you have got. And the second requirement says that using Exhibit 2 in accordance with the IFRS accounting standard, explain with supporting calculations. Again, they're asking for calculations, right? How the new legislation will affect the accounting treatment of assets and liabilities of oil palm division in the year ended 31st December 20x7. And that's for 8 marks. So first we'll solve the A requirement, right? We'll solve the A requirement where we're supposed to explain with calculations, right? So this is the question. This is for 8 marks, right? I'm writing 8 marks over here, 9 marks over here. Because this will help me to ensure I'm writing as per the marks, right? I can't be simply sitting and wasting my time, right? I can't write words 10 marks for a 8-mark question. 8 marks means 8 small paragraphs or 4 small paragraphs with at least 3, 4 sentences, right? So you should have at least 8 valid points in your paragraph. That's when you can earn your 8 marks completely, right? Okay, I'm giving you guys 1 minute. Go through the exhibit number 1, right? Right. And in this itself, you realize there's so many accounting standards that are being tested, right? So go through this exhibit, and then we'll start solving, right? Yes, so you're supposed to read through the case and you will realize there are three, four accounting standards being tested in just this one, 4, 5 paragraph question. Right? There's IFRS 5 in this, there's borrowing cost, there's change in use. Yes, IS 40 is also there. There is even impairment in this question. So just in this 4, 5 paragraphs, they have tested 5 standards for you, right? Okay, so we'll start reading the question. So on 1st Feb 20X7, the management of Arundel Company decided to relocate its food production operations from existing factory to a new premises closer to the principal market. Okay. The food production operations consist of factory building, property, plant, property and equipment, and operational staff. Right. So these are important facts. So on 1st Feb, the company has made a decision that they're going to relocate its entire factory, plus plant equipment and the operation staff to a different location. On 1st March, the company decided to keep the existing factory building and divide it into 4 separate units. Right. And they're saying that these 4 units which they have they have divided the existing factory into 4 different units, and they are saying that these units will be leased out to operating leases, right? Right. They want to lease it out to someone. They want to there's a change in use because earlier the company used to use it for themselves for their own production, but now they're saying they will lease it out to someone, they'll give it out to someone, and they'll earn income from it. Right. It says that Arundel company will sell out all the production plant and equipment. So the factory building will be leased out to someone else. That's a change in use as per IS 40. Right. Then second is that they're saying they will sell all the production plant and equipment. Right. Selling production plant equipment means IFRS 5. Right. It will transfer the existing staff members to another divisions, and the production continued at the factory throughout March and April 2007. Even if the company made decision on 1st March, they continued using the factory for their own purpose till April 20X7. Right. At the year end, on 30 April 20X7, the company stopped using the existing factories. Right. Now it is when a change in use is happening. The company has stopped using it for own personal use. Now they're going to give it out to someone else for earning money. It immediately advertised each item of plant and equipment for sale. Right. So they're trying to give advertisement. They're trying to find an active, they're involved in active, search for a buyer using a broker who is charging commission of 4%. Right. See, they have given you commission of 4% of selling price, which means the examiner wants you to calculate the figure. Right. You're going to calculate the fair value and you have to use this 4% in your answer. Like, don't ignore any figure which the examiner is giving you. right? If they have given you over here 6%, this 6% will be used in your answer, right? If they have given you 300,000 bank loan amount over here, it has to be used in your answer, right? So whenever there is a figure given to you, you should know that it has to be used in your answer, right? So, okay, so we know in plant and equipment what's happening, that the sale will, okay, on 30 April, they have decided that they're going to sell out the plant and equipment. And the commission is 4%. All items of plant and equipment are expected to sell within 12 months, even if they're not sold out by the year end. See, now all of this is highlighting towards IFRS 5. Simply, you are going to write what is IFRS 5, right? How will you draft your answer? IFRS 5 will be written. What is the conditions for recognizing non-current asset held for sale? What is the valuation? What is the valuation? What is the cost? What is the carrying amount? What is the NRV? Right. Since it's not sold out, how will it be recorded? How will it be recorded in your SOFP at the year end? Is there any impairment? Right. So your answer should answer all these questions. Right. So we know as per IFRS 5, there are certain rules to classify if your non-current asset is held for sale, right? So you will write down the conditions, right? That the asset is available for immediate sale. The management is committed to sell it, right? They have an active search for the buyer. The selling price is there, right? You can estimate the selling price. They have given you a broker's charge also, and the sale is expected between 12 months. It does not matter if the sale is happening between 1 year or not, but then the intention should be that they will sell within 1 year, right? So you will write down the conditions, then you will relate to the case, right? You will write down the conditions and then you will read over here what is the case saying, and then you will write down over there, right? And after you write the conditions, after you relate to the case, then you're going to do measurement, right? So your measurement will be the lower of carrying amount and NRV, the fair value less cost to sell. What is the carrying amount of the item of the of the property, plant and equipment? When you write about IFRS 5, IFRS 5, you are supposed to specify at which date is it eligible to become, non-current asset held for sale. So you will write 30 April 20x7 is when the company decided to sell the plant and equipment, right? And then you write the conditions, and then you will justify everything. Then you will write the valuation, right? So what is the carrying amount given to us? Carrying amount on 30 April is given 855,000, right? Use the right figure. You have to use the carrying amount on 30 April because on that date, the conditions have been met to classify as non-current asset held for sale, right? You need to find out the fair value less cost to sell. What is the fair value? Fair value given over here is 870,000, right? 870,000, 870,000. Now, in this, you know that there is a broker, there is a cost to sell. The broker is charging a commission of 4%. So it will be 870 into, you can subtract, okay. You can just multiply into, the commission is of 4%, right? So you can multiply with 96%. You will get the fair value less cost to sell. So 870,000 into 0.96. Your fair value less cost to sell is 88 835,200, right? So 835,200 is your fair value less cost to sell, right? You can do it in the way how SPK has mentioned. That's also a correct way. You can just multiply the fair value into 4%. You get the figure, and then you can subtract from the main value. Right. So we know we have to recognize at the lower of carrying amount in fair value. Right. So you will recognize at the lower, which is 835,200. Okay. In your SOFP at 30 April 20 X5, X78. Right. But then if you see the carrying amount is more than the recoverable amount. Right. Is the carrying amount more than the recoverable amount over here? Yes, right. So there is impairment. Impairment has carrying amount is more than the recoverable amount. Carrying amount is 855,000, but your recoverable amount is only 835,200. So impairment loss of 19,800 will be recorded in your SOPL, right? Yes. So impairment loss of 19,800 will go to your SOPL, right? So after this, after impairment loss goes, there's no depreciation, right? No depreciation will be charged after classifying as held for sale. Okay. Now at the year end, it's mentioned that even if the company's plan was to sell within 12 months, the company could not sell by the year end, right? So at the year end, again, you're going to do valuation, right? You're going to find out the fair value less cost to sell at the year end, and then you're going to compare, right? So at 31st December 20x7, which is at the year end, the assets, the property, the plant and equipment are still there, have not been sold yet. So again, we are going to recalculate the fair value less cost to sell, and gain or loss will go, right? So what is the fair value at the year end? Fair value at year end is 895,000, right? The commission cost is still there, which is 895,000 into 4%. So fair value less cost to sell will be approx 859, 859, 859, 200. Right. So at the year end, your the value of the plant and equipment will be 859, 200. On 30 April, the value was how much? It was 835, 200. Right. Now at the year end, the value is 859, 200. Right. You have to compare. That you can see the fair value has increased, right? It has increased, and we have to reverse the impairment, right? The previous impairment loss of how much was it? Of 19,800 can be reversed. So you're going to reverse the entire loss of 19,800. So the gain of 19,800, which was impairment loss, will be reversed in your SOPL. Thus, at the year end, the plant and equipment will be recorded Add will be recorded at the fair value, which was 835,200 plus the gain. It comes out to be 855,000, right? So this will be there in your SOFP under current assets, shown separately from other assets, right? Okay, this was all for 8 marks. I have shown you the calculations. You should explain this properly in your answer, right? So let's go through the answer now. So simply you're going to specify on which date is the plant and equipment classified as held for sale, which is 30 April, right? 1 mark, easy for you. This is because the plant and equipment are available for immediate sale as they are no longer being used. And then you're going to write out the conditions and you will relate the condition with the case, right? Because the management is trying to commit to a sale plan. They have an active plan to find a buyer. And the price is equal to fair value and the sale is expected within 12 months, right? So all of these So all of this criteria is meeting. So now you will classify it as held for sale. And once the classification as held for sale is done, the plant and equipment should be measured at lower of carrying amount and fair value less cost to sell. Right? You're going to explain the calculation which we just did. Right? We just did a calculation. You're going to explain it. Carrying amount is this much. Fair value less cost to sell will be this much because you account for the 4% broker commission, right? Then you recognize at a lower of both the figures. Then you find the impairment loss of 819,800. You will specify where will the impairment loss go. It will go in operating section of the profit and loss account, right? And then you will mention there's no depreciation charge. Like it's not any rocket science. It's something which you already have, already know. You just need to put it down in a nice way and show it to your examiner. Right. And at the year end, we know that the assets, the planning equipment is still there in the books of the company. So you're going to find out the fair value again. Right. The fair value has increased and fair value less cost to sell is 85,900. 85,9,200, right? So the impairment loss, which you had recognized earlier, should be reversed, but only to the extent it does not exceed the previous loss, right? So 19,800 will be reversed, and the carrying amount of the PPE will be of the plant and equipment will be 855,000, right? And then you will mention about the presentation. Okay, this is what will score you 8 marks, right? Approx 5 marks for your explanation and 3-4 marks for your calculations, right? So just go through this for 1 minute, then we will move on to next one. Okay, I hope this one was clear for everyone. Okay, next we have the factory building. This is for 9 marks. And in this we know there's a change in use. The change in use has happened on 30 April, right? Because that's when 30 April is when the company began to work on division of the property into smaller rented units, and they have given cost, right? The work was complete on 31st December. So on 30 April, they started with some sort of work construction at a cost of 300,000, and the work was completed on 31st December. And in order to do the construction, they got a funding of 300,000 bank loan. Just when I read the bank loan, I knew that, okay, there is IS 23 in this, right? So I'm going to calculate the cost, the finance cost, which is to be capitalized, right? For how many months? For how many months is the construction going on? Right. So what will be right in our factory building? Right. So for this, you're going to first explain what's investment property. That we know investment property. Investment property is when a property is held for earning rental income or gain from capital appreciation. Right. The factory will be rented out to tenants. So it qualifies qualifies as investment property. Right. But then you need to specify on which date is it qualifying, right? Because you can see there are three different dates given to you by examiner. So the company has planned to rent out the building from 1st Feb, right? But then, as I mentioned before, just the management intention is not sufficient from 1st Feb, but then just the management intention is not enough to conclude a change in use, right? The real transfer happens only when there is an actual evidence of change in use, right? When did the first evidence arise? The evidence, it came only when the owner occupation had stopped and they started with redevelopment. They started making some changes just so they can, construct smaller rental units, right? The evidence of change in use happened or occurred on 30 April 2007. The owner occupation stopped and the company started work to redevelop the factory for rental purposes. Right? You can write like this. Yeah, till the date of transfer, we have to treat as per IS 60. And then after 30 April 2007, you start with IS 40. Right? So now we're just justifying just a brief overview of what's happening in the case. Right? We define what is investment property. Now we are saying that when is the change of use actually happening? And then after that, we'll work on the valuation. Right? So evidence happened on 30 April. You need to justify when is the evidence happening? When is there evidence of change in use? And you need to give proper reasons, right? Simply, if you specify 30 June, it's not 30 April, it's not enough. You need to say that the owner occupation has stopped and the company has started working on the redevelopment of the factory, right? So on 30th April 2007, the building is reclassified as investment property. Okay. So over here, what's the carrying amount? What's the carrying amount of the investment property? The factory building. What's the carrying amount, guys? Carrying amount on 30th April 20x7. It's 1,579,500, right? What's the fair value? You have to write this in, a paragraph format. Just for class and revision purpose, I'm writing in, small points, right? Okay, so the company is using fair value method, right? The company uses, over here it's written that the company uses cost model for IS 16 and investment property, for investment property, they use fair value method. So you are going to compare the carrying amount and the fair value, right? On this state, what's the revaluation gain? Simply, when you subtract both the figures, you will get a revaluation gain of 175. Okay, 1.75 million. Right. So this revaluation gain, right, 170,500 gain will go to your OCI. Right. And this will not be reclassified to profit and loss. Okay. So at your investment property and at initial, it will be recorded at 1.75 million. Right. Your gain in OCI is 0.175 million. Right. Is this clear for everyone? If you see, there is some development cost over here, right? The company is spending approx 300,000, right? Okay, can you repeat revaluation? See, the company, it follows, fair value method, right? And when there is a change in use, you are going to compare the carrying amount with the fair value, right? From IS 16 to property plan, from IS 16 to IS 40, you're going to compare the carrying amount and the fair value. Any gain or loss, right? Any gain or loss, it's going to your OCI, right? Revaluation gain is going to OCI. So revaluation gain you're getting over here, it's 1,750 minus 1,579,500. You're getting a gain of 175,000, right? This will go as revaluation gain in OCI, right? Okay. So after this, if you focus a bit more in the case, there is development cost. Right. The company is incurring extra costs to convert the owner occupied factory into for rental units, right? So that extra cost which the company is incurring, the company is spending 300,000, that is going to be capitalized as a cost of property, right? So the company spent is spending 300,000 to redevelop the factory into rental units. Right. This amount will be capitalized as the cost of investment property. Right. We know simple property plant equipment, simple investment property rule is at any cost which is directly attributable is capitalized. Right. This cost of 300,000, it is to be capitalized because it's directly attributable. So the new carrying amount will be the fair value which we had on 30 April, fair value on 30 April, plus the extra cost which is incurred by the company, right? So our fair value will be 2.05 million, right? Or 2.05 million, right? So this is the carrying amount of the investment property on 30 April 20 right? See how just in one small question, they have so many accounting standards, right? So you should, when you read through the case at that time itself, you should know which accounting standard are the mentioned, right? You should have this quickly, you should revise the accounting standard, right? After that, we also know there is borrowing cost, right? Because the company has taken loan of 300,000 was taken, right? What does the standard say? Any borrowing cost on qualifying asset should be classified, should be capitalized, right? Should be capitalized, right? Investment property, it is a qualifying asset. So what will be the borrowing cost? Borrowing cost will be simply 300,000, right? 6% is the interest rate given to us. And for how many months are we going to capitalize? When did the construction start? This started in May, June, July, August, September, October, November, December. So within 8 months, they were done with entire redevelopment. So you're going to capitalize for 8 months out of 12 months, right? So the borrowing cost will be 300,000, which is the entire amount, into 0.06 into 8 months, divide by 12. So the borrowing cost will be 12,000. This will also be capitalized, right? So the new carrying amount, which we figured out, was 2.05 million. You're going to capitalize the borrowing cost, right? You capitalize the borrowing cost. So now your carrying amount of the investment property will be 2.062 million. Right? Is this clear for everyone? This is on 30th April. Is this clear for everyone, guys? Okay. Now we have to figure out what happens at the year end. Right? At the year end, we know the carrying amount, the fair value on, the carrying amount on 30 April, we calculated is 2.062 million. In the question, it's given, the fair value is given. Fair value on 31st December is given to you. Right? How much is the fair value? 2.120 million. Right? So you're going to remeasure the investment property to fair value, right? Gain or loss. When you subtract both of the figures, the gain or loss will go to your SOP. So your gain will be how much? Mm, 2.120 minus 2.062. Right, so your gain will be of 58,000, which will be credited to SOP. Right, is this clear, guys? So this entire calculation which you have done over here with explanation, it should be there in your answer, right? If you don't explain, then you're going to lose marks. Simply just calculation is not sufficient. You need to justify each and everything, right? Is this clear for everyone? I have used almost all the figures which is given to me, right? I have used all these 6 figures, the carrying amount, fair value, each and every date, each and every item. I have used everything in my answer. So even you should make sure you are not missing out any figure from the exhibit in your answer. This is the write-up of the answer. You guys can go through this. I'm giving you 2 minutes. Go through this. Right, in this answer, they have given you two options. You can either capitalize the borrowing cost or you can simply expense it out, right? So I have done the calculation while capitalizing the borrowing cost, but you can do it in the other way also, right? The examiner is giving you two options. You either expense it out or you capitalize, right? So accordingly, you will find the answer. So just go through this answer. Okay, has everyone gone through the answer? Any doubts? You have to explain everything. See, there's a calculation, you have to explain it. Revaluation gain is there. Where will the revaluation gain go? Right? Will it be classified, reclassified to property, plant, equipment? Right? The borrowing cost, which you're supposed to capitalize. What is the borrowing cost that you're going to capitalize? For how many months will you capitalize it? Right? What is the amount at the year end? How much is the gain? Where will the gain go? Right? All of them should be mentioned in your answer. Okay, next we'll read the next requirement. Using Exhibit 2, in accordance with IFRS accounting standard, explain with supporting calculations how the new legislation affects the accounting treatment of the asset and liability of the oil palm division in the year ended 31st December. So you're supposed to check if how is the new legislation affecting the accounting treatment of the company, right? So this is the case. It's quite lengthy. Okay, so we have Arundel company which operates an oil palm division. Okay, oil palm division which produces palm oil for use in biofuels. The division includes an oil palm plantation and a processing plant, both of which were brought into use in 20X1. And right now we are in 20X7. So approx 6 years since they are using the oil palm plantation and the processing plant. And it is expected to be used for more 25 years. Right? Important points. If they're giving you figures, if they're giving you dates, you're supposed to focus on them. Right? The production processes involves a growing fruit on oil palm trees. It's used for harvesting. It's then processed into extract palm oil. The palm oil is then sold to biofuel producers. Okay. On 31st December 2007, at the year end, a new legislation was announced to combat deforestation and reduce greenhouse emissions. So basically, the government of the country, they came up with a new legislation, which means new rules, new law to reduce the impact of deforestation and greenhouse gas emissions. So, which is prohibiting the use of palm oil, right? The company's entire concept was producing palm oil for biofuel, right? But now the new law has come, which is specifying that palm oil cannot be used as a biofuel from 1st January to 20Y2, which means 2 years, like, next year, which means approx, yeah, 4 years time, right? So within 4 years, they cannot produce palm oil and it cannot be used as biofuel. Now, this is a indicator of impairment, right? Do you guys agree? This is a huge impairment indicator. The palm oil division is a cash generating unit, and at the year end, the carrying amounts are given. So from this, I can understand that I will have to, find out the impairment and then I'll have to allocate the impairments, right? So I know the CGU is, okay, they have given us the carrying amount. We will use non-current asset, land, property and equipment and oil palm trees, right? Remember, current assets, they're always at recoverable amount. So you cannot charge any impairment against them, okay? The initial carrying amount is given, which is 450,000 at 31st December. Expected future cost to reforest the land is unchanged. The present value is given, which is 3.15 million. The fair value less cost to sell is given. So with this information, you will have to find a recoverable amount, right? So first, we will find out what's the impairment, right? Let me know what is the recoverable amount, guys. What will be the recoverable amount for the palm oil division? Right, with this figure, with this paragraph, you can figure out what is the recoverable amount, right? So do let me know. Right. So we're going to start with this answer. First, we're going to explain that, the new legislation is indicator of impairment. And since this is a CGU, the company must compare the carrying amount with the recoverable amount, find out the impairment loss, right? What's the carrying amount? Is it given to us? Carrying amount is given to us, right? Okay, we'll figure out the carrying amount. First, let's figure out the recoverable amount. Recoverable amount, it's always the higher of fair value and value in use. Fair value is 5.1 million, right? It's given over here. And the value in use is 3.5. Value in use is 3.5. So higher of this means that your recoverable amount is 5.1 million. Right. So we know the recoverable amount is 5.1 million. Right. Next, we're going to calculate the carrying amount. Now it says that the carrying amount for the carrying amount, we have the land property equipment, right, which is approx 5408. Right. We have the oil palm trees, which is 594. And with this, you will have to subtract the reforestation provision. Why is that so? Because it says that the initial carrying amount of the plantation included a legal obligation to reforest, right? This legal obligation is included already. We'll have to subtract this because any buyer would take over this obligation, right? The carrying amount of 450,000 will be subtracted from the carrying amount of the CGO, right? So you will subtract minus 450. And then as I mentioned, current assets, we will not use them in finding out the carrying amount because they are always at the recoverable amount. Right. So total carrying amount is equal to 5408 plus 594 minus 450, which comes up to be 5552. Right. So next you have to calculate the impairment loss. Carrying amount more than fair value. What's the carrying amount? It's 5552. Fair value is 5.11, 5.00. So your impairment loss is approx 45200. Right? Did everyone understand this impairment calculation? This impairment loss will go to your SOPN. Right? And after this, we will do allocation of impairment losses. Right, so let's read the answer. At Arundel company, it identified that the new legislation was the indicator of impairment. On 31st December 2007, in accordance with IS 36 impairment of asset, a CGO should have been tested for impairment. Right, so we figured out the recoverable amount will be 5.1 million. Then you have to, you have to find out the carrying amount, which should be calculated on consistent basis. Right. It should include the non-current assets, which included the recoverable amount calculation. It should include the reforestation provision, since it cannot be separated from land, and any buyer who is buying the land will also have to assume the associated liability. Right. Next, you have, so this is the carrying amount which we had calculated. Right. Impairment loss of 452,000, it arises. It should go in operating section of your SOPL. Next, after that, you're going to allocate the impairment loss between the land property equipment and the oil palm trees. Right. So the oil palm trees, they are bearer plants, and you should know that bearer plants are always accounted for as per IS 16. Right. Bearer plants are accounted for as per IS 16 rather than biological assets. So IS 36 will apply to it. Right. So we have land property and equipment. We got the carrying amount of 6002. We have the impairment loss, and then you will do allocation. right? After doing allocation, you'll find out the carrying amount. Carrying amount of land, property, and equipment is 5001, and the oil palm trees is 549, right? After recognition of the impairment loss, the non-current assets should be depreciated over the remaining useful life. Right after you do impairment, depreciation will happen over the remaining useful life. It will be reviewed at each financial year end, and it should be checked for impairment every year. Yeah, right. You will check for impairment. You will check if there's an indicator of impairment. Right, the remaining useful life of palm oil is 4 years, and useful life of land property is also likely to be reduced. Okay, was this clear for everyone? So you simply have to justify whatever figure is given, you calculate the recoverable amount, you calculate the impairment, you have to find out the allocation of the impairment loss in CGU, and then justify the presentation of the figures, right? Is it clear for everyone? Can we move on to next question? Just give me a confirmation, guys. Okay. So our next question is Caroll Company. It operates in leisure and recreation sector. It prepares the financial statements in accordance with IFRS accounting standards, and its financial year end is 31st December. There are two exhibits given to us. One is a convertible instrument, and next is a key performance indicator. So one is from investor perspective, other is just a basic, convertible. Uh, right. So we have got three requirements. A, B, C. In the first requirement, they're asking us why Caroll Company should recognize the convertible loan notes as liability and convertible preference shares as compound instrument. Right, they're asking the difference between why should the convertible loan note be liability and why should the convertible preference share be compound instrument. Then you're supposed to explain with calculations. Right. Simply, I'm going to copy paste the requirement so I don't miss out any aspect of the requirement in my answer. This is completely for 11 marks, right? So you can believe calculations will be for 3 or 4 marks. Rest everything is for explanation. Okay, so let's read through the exhibit. So the management of Caroll Co. is considering issuing one of the two financial instruments to raise 5 million. So the company wants to raise 5 millions, and they have two options, which is the 5 million convertible loan notes, and the other one is 5 million convertible preference shares. Right. The loan notes each have a par value of $1,000. Right. And they must pay a coupon interest of 9% each year in arrears. It's redeemable at par. And there's an option at the end, there's also option to convert into shares, right? The holder may convert the loan notes at any time during a 3-year term into variable number of ordinary shares. So we have debt and equity both over here, right? And if it is converted to shares, it can be converted to shares whose total fair value on conversion is $1,000. The second option is the preference shares will be issued at par. An obligation. There is an obligation, right? Remember, whenever there is an obligation, we should know that it is a liability, right? Obligation is liability. To pay compulsory annual dividend. Compulsory. It's liability. 3 years Yeah, okay, it's not liability, it's okay, we'll read further. 3 years after issue, the shares should be mandatorily converted into ordinary shares, right? So at the start of the year, they had some obligation that they have to pay annual dividends, right? And 3 years after issue, they got an option that now maybe they can convert into shares, right? There is no option to redeem for cash. Similarly, non-convertible preference shares pay a 12% annual dividend. So our questioner was asking, explain why convertible loan note is a liability and convertible preference shares compound instrument. Right. So we know convertible loan note over here. In the convertible loan note, there is a compulsion to pay coupon interest of 9%. Right. There is a compulsion of paying interest of 9%. 9% interest should be paid, and it's redeemable at par, which means you're going to repay $5 million if the holders redeem the notes. Right. So there is a contractual obligation over here. You are supposed to pay the interest of 9%, and if the holder, if the, see, it says that the holder may choose to convert the loan notes at any time during a 3-year term. So there is an obligation over here, and since there is a contractual obligation to pay cash, it is a financial liability, right? Right. And the conversion option is there where the holders can convert the loan into ordinary shares. Right. Loan can be converted to ordinary shares. And the number of shares depend on the price. Right. Price over here is $1,000. This means that the holders will receive a variable number of shares. Right. And whenever there is a variable number of shares, it's a liability scenario, right? Variable number of shares, when the number of shares are not fixed, it's a liability, right? Variable number of shares means it's a liability. If the number of shares are fixed, it's equity shares. So the entire, and then you're supposed to give a conclusion line. The entire convertible loan note is classified as financial liability. And how will you recognize this in your financial statement? We know the initial liability will be 5 million, which is the entire amount, right? Which is the par value. 5 million, and the finance cost will go to SOPL. How much will it be? It will be 5 million into, what's the percentage over here? 9%, right? Right. The coupon rate is 9%. 5 million into 9%, which is approx 0.45 million, 0.45 million, which will be debited to SOPL. Right. So this is what you're supposed to write about your convertible loan notes, along with the explanation and the calculation. Right. Is this clear for everyone? Since there is an obligation to pay interest and it's redeemable at par, right? And the number of shares is not fixed, it's variable. It depends on the price of the share, right? Then in that scenario, it's a liability. So we'll record has convertible loan, has a financial liability, initial liability 5 million, and finance cost will be 5 million into coupon rate, which is 10%. So 0.45 will be your finance cost in your SOPL. Next, we have the convertible preference shares. Right. Now, this was simple. This was that there is an obligation. Plus, you can do conversion to shares. Right. So, this is a basic compound instrument. right? So you will have to calculate the liability and the equity component. You can do this calculation on the spreadsheet. Right. So what was the par value? 5 million. Right. What is the rate? How much was the rate? 9 percentage? Or is it 12 percentage? Uh, it's 12 percentage, right? What is the rate we are going to use to discount, guys? Okay. Um, the coupon rate is 9 percentage. Right. Coupon rate is 9 percentage. Right. For discounting, we will use the rate which is given of 12 percentage. Right. Similar non-convertible preference share will pay annual dividend of 12 percentage. So your discount factor will be at 12 percentage. Right. So what's the cash flow? 5 million into 9 percentage. So 0.45 is the cash flows which you're going to discount. Okay, this is for how many years? 3 years, right? So year one, three. Right. At the end of year three, you also have your redemption at par, right? So at year one, you have 0.45, year two, 0.45, and year three, you will have 5. Right. Okay, only for redemption is not written over here, right? You will okay, redeem. There's no option to redeem for cash, right? So there's no option, so you won't do any redemption over here, right? So in year three, only 0.45, which is the cash flow, will be recorded, and you won't record 5 over here, right? And what is the discount factor? We'll have to calculate. 1 divided by 1.12 raised to, right? Right, so present value, discount factor, cash flow. Same way, I'll copy paste. Okay, it's not working. Right. So when you add all of these, you'll get the present value, you'll get the initial liability. So your liability is 1.0808 million. Your equity component will be simply 5 million, which was the par value was 5 million. So when you subtract 5 billion with your liability component, your equity component is 3.91 million. Right? Is this clear for everyone? How did we find out the equity component over here? Right? I simply found out the discount. I found out the present value of the future cash flows. Right? I have not taken the redemption amounts because there is no option to redeem for cash. Right? So I have taken 0.45 into the each year discount factor. I got the sum of the present value, which is the liability. I compared with the par value and I got the equity component, which is 3.91. Right. Okay. So this was all about equity. And then at the year end, you will have a finance cost, right? Which is the liability is there, 12% is finance cost. This will go to your SOPL, right? In your SOFP, what was the liability? Total liability was 1.08. In this, you will add the finance cost because your liability is increasing, right? And you will subtract the dividend, right? It says that a compulsory dividend should be paid, right? So the cash dividend of 450,000, which has been paid, will be subtracted. So minus 0.45, right? So at the year end in the balance sheet, your closing liability will be 0.76. So closing liability is 0.7605. Right, guys? Is this clear for everyone? You're supposed to explain this calculation in your answer. Is there any doubt in any of the calculations? Do let me know. Okay, after that, we have a second requirement. Explain using exhibit 2. Right, so using next exhibit, the impact of each convertible instrument and the impact of each convertible instrument would have on gearing and adjusted profit before income tax for the annual year. So now you're supposed to check how much is the compound instrument and how much is the liability affecting the gearing and the adjusted profit of the company, right? So we know, right, the convertible loan notes are completely liability, right? If it's completely liability, our gearing, which is calculated as debt divided by debt plus equity, over here only the debt will be increasing, right? So it means if convertible loan note is taken, the gearing will increase, right? You'll have to calculate how much percentage the gearing will increase, right? Because in convertible loan note is completely just a liability, only your debt will be increasing, and the gearing formula is debt divided by debt plus equity. So your debt is increasing, which means your gearing will be increasing, right? The same way, only debt is increasing, equity is not increasing. Right. So higher debt with no matching increase in equity leads to higher gearing. But after that, you will have to calculate the gearing and what will be the impact on the profit. The company will have to give 9% finance cost. Finance cost reduces the profit. Right. The other one, which was a compound instrument, over here it has equity plus liability. Right. So over here, gearing will be affected, but here both debt and equity is changing. Debt and equity both are increasing, right? So it won't have a huge impact on gearing ratio. Gearing will increase, but it won't have a huge impact because both debt and equity are increasing together, right? Same thing over here, since we have the finance cost, that will affect or reduce the profits in SOP. So you have to give a small conclusion paragraph also. After you explain the basics, you're supposed to calculate the gearing. What is a new gearing when convertible loan is taken? What is a new gearing when the compound instrument is taking place? What is a new profit if you consider both of the options? And then give a small conclusion paragraph, right? So let's just go through the answer. Here, this is the answer. The issue of convertible loan note will result in additional liability at 1st January 2008. This is an increase in debt without a proportionate increase in equity, which will result in increase of the gearing ratio. Right? The issue of convertible preference share will result in additional liability and additional equity. right? And then you can calculate the gearing ratio. How much is the gearing increasing? Because of the convertible preference shares, the standalone gearing ratio is 21.6%. And then, right, and the standalone gearing ratio for convertible preference shares at the year end is 16.7. Right. So you can see that the overall gearing ratio is decreasing. And what is the impact on the adjusted profit? The profit before income tax for the year end, both will be affected, right? But then both of them will be affected because of the finance cost, right? So because of the convertible loan note, this will result in additional interest expense of 450,000, while the convertible preference share will result in additional interest of 129,699, right? So both of the instruments are affecting the profits, right? So this is how you're supposed to write the answer, right? So the conclusion, you can write one conclusion paragraph also, that convertible loan notes, they are increasing the gearing more because they're completely dead, right? Convertible preference share is reducing the gearing pressure because it includes both debt and equity, right? And both of them are going to affect the profits because because finance cost is there. However, the finance cost of convertible preference share is lower than the convertible loan notes, right? Okay, is this fine for everyone? Shall we move on? So next is key performance indicators, which provides information about key performance indicators calculated for the year ended 31st December 2007. So the company, yeah, the second exhibit, they have, yeah, so this is about management, it's about NPM, right? Management defined performance. And this is the investor perspective question. This is for 7 marks plus 2 marks for the professor marks. So this is 9 marks for you. And then if you notice, you cannot find any much information about this in the exhibit, right? They have just given a very small paragraph over here that the company is expecting minimal changes to financial performance or financial position. And they will refer to both of these KPI in press release and investor presentation. Nothing else is given over here. So you have to explain by your own knowledge in accordance with IFRS 18 why adjusted profit before income tax meets the definition of management defined performance measure, but gearing does not, right? Why is adjusted profit a measure of MPM, but gearing is not a measure of MPM? Right. You're supposed to outline the disclosures about the adjusted profit, which is required by IFRS 18, and discuss why these disclosures will provide useful information to the investors. Right. And you have 2 marks for clarity of the answers. Right. And relevance of the answer. So this is the answer, but even if you write something other than this, right, other than this, which you think is logically correct, then you're going to score a mark. But then you should know what is the MPM, right, as per IFRS 18. MPM is a subtotal of income and expenses, which is used in public communication outside the financial statements, which complements the IFRS accounting standard subtotals, right? Adjusted profit, why does it meet the standard of MPM? Because it is a subtotal of income and expenses, and it is used in public communication such as press releases and investor perspective. However, gearing does not meet the definition because it uses balances from SOFP rather than being a subtotal from income expenses. So we know MPM It's basically a subtotal of income and expenses, which is used for public communication. And adjusted profit is one of the measure because it includes the income and expenses. However, gearing, it includes debt divided by equity, which is balance from your SOFP. So it is not a measure of MPMP because we need the income and expenses for MPM, right? What is a disclosure of MPM? IFRS 18 requires that the company discloses information about adjusted profit within its financial investment, which is useful for investors, right? It must clearly identify that the adjusted profit before income tax provides management's view of company and explain why this measure is useful in providing information about the performance, right? It should disclose what is the MPM, why is this MPM useful in making decision, how is the MPM calculated, and explanation of any adjustments made, right? So you can just learn this and then you can write in your paper, right? Information about how MPM is calculated, explanation of why adjustments are made for fair value movements and any non-recurring events, right? The main aim of MPM is that investors are able to see the company from the management's perspective. So they can understand the company's performance objectives and achievements. Right. A numerical reconciliation and narrative explanation of MPM also means that investor can compare the performance year to year, right? Simply MPM is just so the investors can understand the management's perspective. So the investors can compare the performance of previous year, this year, and what can be the future performance of the company. Why are the management making certain decisions? What is the point of view of the management, right? So nothing but information provided about MPM. It allows the investors to understand the business better, to understand the profit before income taxes. It helps to understand why is management making certain decisions and how these decisions are evaluated and calculated. Right. So even if you write this answer in a very, easy language as per your own understanding, you're going to get marks. Right. It's not important that you write such complicated answer like the examiner has written. You can write your own easy answer, comparatively an easy answer, and then you can still score very high marks, right? So what should be included in MPM? There should be an explanation in MPM. What should be included? I'll just write down over here. What should be included in MPM? Like explanation of the measure. Right? Why is management using it? What type of adjusted profit is used? Why is it useful to the investors? How the MPM is calculated? Right? Proper method, any adjustments, why are the adjustments made? What is the logic behind the adjustments? Everything should be mentioned so that the investors can understand the perspective of the management. Right? And the MPM should be reconciled to the IFRS subtotal. Right. So profit before tax should be reconciled with the adjusted profit. It's important, right? We have a question over here. Why is it important to investors? It's important because it helps to compare the performance, helps to understand management decisions, identify one-off items, makes their own assessment of future profits. Right, these are just small points I'm giving, so you can, kind of learn. But then please don't write in this small pointers, right? You won't score marks if you write like this. You're supposed to write in small paragraphs, right? So over here, if you see there are three different requirements just for 7 marks, so at least you should have 2 paragraphs per requirement over here, right? So any doubt over here, guys? Any doubt in your third question and the fourth question? You should know what's MPM. You should know the changes in IFRS 18. This helps a lot. Right? This will help you a lot to draft your answer. Right. So, by chance, if you guys are someone who has not given a mock exam yet, so I highly recommend that you give a mock exam. This will kind of give you a reality check about where you are standing in comparison to the examiner, right? What is the answer of the what's the answer as per examiner? What have you written? So this will help you to understand where you are standing. Right. So if you're someone who has not enrolled in with me in my test series, or if you have not enrolled in my mock evaluation already, you can enroll for 499 INR or $10. You can enroll for the mock evaluation where you will get mock evaluation of the pre-June 2026. You will get detailed answer script evaluation and detailed voice note feedback. Right. And if you're someone who wants access to the third day of the webinar, which will be held tomorrow, our focus will be on revision of remaining standards. We will focus on section A, right? The pre-populated sheet. I'll show how to do it by from scratch. And I'll also evaluate the examiner comments. So if you're someone who is interested in the webinar, or if you're someone who wants mock evaluation, do let me know. Message me on WhatsApp. You can connect with me, and then I'll let you know the price, then you can join me, right? Other than that, if you're someone who wants both the webinar access and the mock evaluations, so we have a fast track course. I think it's around 2000 rupees. So where you will get access of the webinar day two, and you'll have two mock evaluation. Now the mock evaluations, you'll get detailed feedback. You will get proper doubt support till the exam date, and you'll get, whatever help you need from my side, I will be helping you out, right? So if you need to enroll with the mock evaluation or the webinar access you need, or if you need the fast track course, then do let me know. You connect with me, and then I'll assist you out, right? This is my phone number. You can save this number if you have any doubts, if you have any queries, do let me know. I'll try my level best to help you out, right? Thank you for joining, guys. If there's any doubt, please let me know.